start, Maryam Shaji?
Ma'am.
Welcome you all to today's session on CARO 2020, and we have our learned speaker CA Pravin Sethia ji today, and we are privileged to have our past chairperson Preeti Savla. I request her to give us a welcome address, and then before that, let us have a ICI motto.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तदेव शुक्रब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्द्वैता 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 एतद्द्वैता.
Now I request Preeti ma'am to say a few words and enlighten us about the WIRC events and your thoughts.
Thank you, Nidhi. And Palak, the coordinators for the session, learned speakers here, Pravin Sethia, and all dear participants. A very good afternoon to everyone. And friends, about the event, so we have now coming up with international conference, and this time it is at Geo, at PKC, at Geo Center, and one of the best conference I would say, and it is on physical mode, and the speakers are excellent international faculties, and the topics are also all must be liking to it. So that is what I request all of you to please join for the same. Be able to see on the website, you can enroll for that. We are coming up with the convocation for the students who have cleared CA. It is on 29 and 30th. So we have not we were not having convocation since 2019 passed out students. So now that is planned on 29th and 30th of this December. So if anyone has not received any information or invite, you can feel free to connect with us. And I hope this year has passed away and everyone want that to pass as early as possible. And we are awaiting to welcome 2022 in a big way, and with a great with good health. I wish good health, and all this COVID and Omicron, which is coming newly come up virus, should not be there. It should go away with this 2021 December 31st. And I wish a very, very healthy and safety for each one of our members. And anyways, a lot of members are asking about the extension of the due date for income tax. So a lot of representations have gone to the ministry, and let us hope what is the outcome of the same. Again, as regards to the CARO has also been revised, and it has been postponed the implementation of new CARO. And again, Schedule 3 is also under revision, and that will also come on the table of the council in the forthcoming council meeting. So, but Schedule 3, which is revised one, is very, very complicated. Let us see what best the council decides and whether this Schedule 3 is being applicable or not. So let us wait and watch. So again, once again, on behalf of WIRC and all of you, I welcome CA Pravin Sethia for this session. And I hand over to Palak for his introduction.
Good evening, everyone. It, it is a great pleasure for me to introduce our speaker who is going to talk to us about CARO 2020. This is the subject in which we are all interested because CARO 2020 is a new format for issue of audit reports in case of statutory audits of companies under Companies Act 2013. So our speaker for today, Pravin Sethia sir, is a chartered accountant and a member of Institute with about 15 years of professional experience working with a large professional services firm in India. He is experienced in managing large complex audits of several large Indian listed and multinational clients in broad range of industries. Sir has contributed several articles in ICAI journal and has delivered lecture at the professional forum. So without further ado, I would like to welcome Sir to deliver the presentation. Sir, the floor is yours. Thank you.
Thank you, Nidhi, for this wonderful introduction. And good evening, everyone, and welcome to this session on CARO 2020. My voice is audible, right, to everyone?
Yes, sir.
Yeah. So, CARO 2020 is an extremely relevant topic for financial year 21-22. And, the upcoming financial statements for March 31-22. While Nidhi just briefed everyone about my professional side of the story, but I would just like to spend a few minutes on the personal side of my story. So I was born in Rajasthan and I was raised in Mumbai. Currently, I stay in Mumbai, Kandivali. I'm married. I have a son actually who spends most of his time playing video games as opposed to studying. And in my free time, I prefer to listen to old Bollywood song music on my Saregama Karwa, which is very helpful to relax and rejuvenate. So with that in background, I will just give you some, I would say, a background in the sense that in terms of structure of the today's presentation. So we'll start with an overview in terms of what is the background about this CARO 2020, and then we'll dive deeper into some of the updates that are made as a part of CARO 2020. There are certain clauses in CARO 2020 which has not undergone a significant change, so we'll briefly touch upon that. And lastly, we'll have some time for Q&A to clarify any doubts that you may have. So with that, I will just start with my presentation. So when I look at financial year 21-22, it is very exciting and unique in the sense that there are so many amendments and updates that are coming up which are relevant from a financial statement reporting point of view, right? As for example, Preeti just mentioned about the updates to Schedule 3. It is a very significant development in terms of the disclosures, enhanced disclosures which are there in the financial statements. That is one. So that is one. Secondly, when you look at the auditor's report, there are specific clauses which are brought in where the auditor is required to comment upon whether the funds received by the company are received with an understanding to invest further into an ultimate beneficial company, right? So this is one of the very onerous requirements which will be there for March 22 audit report. And lastly, the enhanced version of CARO 2020, which is there and which is we are going to talk about in the today's presentation. So with that, I will just start with an overview section. So CARO 2020, as everybody is aware, was notified by MCA somewhere in February 2020. Initially, the plan was that this will come into effect for financial year 19-20, but subsequently on account of COVID and other developments, it was deferred for March 21 and also subsequently got deferred to March 22. So currently, the way the standard is, CARO 2020 is applicable for audit of all financial statements which are having a financial year ended beginning on or after April 1, 2021. So effectively for F1 2021 and sorry 21-22, CARO 2020 is applicable. There are certain classes of companies which have December as their financial year end, right? For example, companies which will prepare their accounts for the calendar year December 2021. For those category of companies, this CARO 2020 is not applicable. They would continue to apply the old CARO, which is CARO 2016. And when they come in December 22, they would apply the revised CARO 2020. So this is on the overall effective date of implementation of CARO 2020. Now, when you look at the objective, what was the need to bring so much change, into this CARO 2020? Let us try and understand briefly about that. If you look at some of the amendments around Schedule 3, some of the enhanced disclosures in CARO 2020, what it appears that now among the regulators, there's a growing focus to get more and more qualitative information about the governance, the functioning of the company, the way they raise funds, the way they deploy their funds in terms of investments, loans, how those are getting utilized, etc. So there's a growing focus around those areas of more of a qualitative functioning of the company, and also to provide valuable information to the stakeholders, be it shareholders, be it bankers, be it government authorities, etc. So that they can read the financial statements not only for numbers, but also for some of the qualitative aspects of governance and the functioning of the company. So this is an overall, I would say, objective of why there's so much change happening in this financial reporting framework, right from Schedule 3 perspective and also from CARO 2020 perspective. Just to give you an indication, in CARO 2016, we had about 16 clauses and about 8 subclauses. Now in CARO 2020, the number of reporting requirement has increased to about 21 main clauses and about 32 subclauses, which is quite a substantial increase in the size of the reporting that is required to be made under CARO 2020. Moving on to the applicability part. So CARO 2020 is generally applicable for all categories of companies, listed companies, unlisted companies, as well as private companies. There are certain exempted categories of companies to which CARO is not applicable, and those are on the screen. So it is banking company, second is insurance, third is Section 8, 4 is one-person company or small company, and if it is a private company with certain threshold like paid up share capital not more than 1 crore, borrowings not more than 1 crore, and total revenue not exceeding 10 crores, these are the categories of companies which are exempted, and for those companies, CARO 2020 is not applicable. This requirement is not different when I look at CARO 2016, and hence there's no change in terms of the applicability requirement of this CARO 2020. If I look at the last condition, which is relating to private companies, what you need to ensure is all the 3 conditions need to be complied with. So for example, if company has paid up share capital less than 1 crore and even borrowing less than 1 crore, but let us say the turnover is about 15 crores. In such case, CARO 2020 will be applicable because all 3 conditions need to be complied with. So this is just a background and overview of CARO 2020. I will move to the next slide. On this slide, I have summarized the entire summary of what are the different clauses on CARO 2020. So if you look at it, there are about 21 clauses. And the gamut is quite wide. If you look at it, starts from property, plant and equipment, goes on to inventory. There's a reporting about investments, securities, guarantees, advances at clause 3. There's a reporting around repayment and usage of borrowing at clause 9. There's a reporting around cash losses, the financial position of the company, and finally, CARO 2020 is also applicable in case of consolidated financial statements, whereby there's one clause which will be relevant so far as consolidated financial statements are concerned. So clause 21 is more to do with report on consolidated financial statements, and there are others which are more applicable from a standalone financial statements point of view. So this is an overview of different clauses which is there as a part of CARO 2020. Now, with that background, let us go through what are the key updates that has happened in each of the clauses of CARO 2020. So the first and foremost is property, plant and equipment. If you look at my screen, you can see there's a I'll just show a presenter. Yeah. So if you look at it here, wherever there's an enhancement of the reporting, I mentioned here as enhanced reporting. If there's a new reporting, then I mentioned it as a new reporting, which means if the requirement has increased for the same clause, it will be an enhanced reporting. And if it is altogether new reporting, you will come to know that, okay, there's a additional new clause which has been inserted, or a subclause which has been inserted as a part of CARO 2020. So the first one is around title deeds of immovable properties. This was there in CARO 2016. Now, what has changed in the CARO 2020? So there are 2 things which has changed. First is previously when we were looking at CARO 2016, the reporting was generally understood to mean verifying the title deeds of immovable properties which are forming part of property, plant and equipment only. It was not supposed to be covering immovable properties which are classified as maybe investment properties, immovable properties which are classified as held for sale, etc. Secondly, in CARO 2016, the auditor was not required to report in case where the leased properties, the cases of property like building which are taken on lease, but the title deed or the lease deed is not in favor of the company. That was not the requirement to be reported under the CARO 2016. But when it comes to CARO 2020, auditor is required to report even for the immovable properties which are taken on lease, whether the lease agreement is in the favor of the company or not in the favor of the company. Right? So if I look at the comparison, one is now it is required to cover immovable properties forming part of investment property held for sale. That is one requirement that has increased. Secondly, there's an increased requirement to report on the leased immovable property as well as compared to earlier CARO 2016 where it was not the case. So this is an announcement. And secondly, the CARO 2020 also prescribed the format of reporting. Previously, there were different formats which were reported by the auditors, and thereby there was no consistency. But with this format being specified, it becomes much more easy to ensure that all the auditors, report in the same lines for the specified format. So this is one of the key development that has come. What is more important, maybe relevant for you, for the fraternity, is just look out for transactions like mergers, acquisitions, amalgamations, etc. Because normally those are the cases where when the amalgamation happens, the title deeds of those immovable properties would be in the name of the seller, and it will take some time for the companies to actually transfer those name in the name of the acquiring company. So that is an important element that to watch out for. That is one. Secondly, if there's a large company and there's a large portfolio of immovable properties which are classified as investment property like land bank, like buildings which are put on rent, etc. Those are the things where you need to be mindful in terms of collating those information, ensuring that those title deeds are verified, and then if there's an exception, those are being appropriately reported in the CARO report. So large companies with large portfolio, geographically diverse operations, many properties can be a challenge in terms of this reporting. There could also be a situation where the original title deeds are actually mortgaged with banks or financial institutions because company has obtained borrowing. In such situation, I think historically we have been obtaining confirmations from those financial statements and banks, and hence the similar procedure would continue to be performed as a part of our reporting for CARO. So this is an update on immovable properties. I will move on to the next section. Now, second update, which when it comes to property, plant and equipment, is about revaluation of property, plant and equipment or intangible. Now, this reporting is applicable only when company follows a revaluation model for the purposes of reporting the carrying value of property, plant and equipment or intangible assets. Here, auditors are required to report on two aspects. One, whether the revaluation is performed by a valuer which is registered under the Registered Valuers Rules 2017. That is one update. And second update is that if the valuation results into an increase or a decrease of more than 10% in the net carrying value of each class of asset, which is of PPE or intangible asset, then the details and the amount of change needs to be reported as a part of this clause. So two things, whether it is as a part of the registered valuer, and second is whether if it is more than 10%, then you report the amount. So here what is important to note is this 10% criteria is for each class of the asset. So you need to compare what is the value before evaluation, after evaluation for maybe building, land, property, plant and equipment, or any other asset for each class, and then ascertain whether it is more than 10% or less than 10%. If it is more than 10%, you report the amount. If it is below 10%, you don't report the amount. So that is the requirement which has come up and which is required to be reported by the auditor. There's a similar requirement under Schedule 3. So auditor, when they are actually making a report on CARO for this aspect, it is required that they corroborate and cross-check in terms of what is the information that is being reported in Schedule 3 by the management in terms of the valuation gain, the valuation change, etc., and ensure consistency of information that is being reported as a part of this clause. So consistency is very important to be looked at. When I looked at the when we look at the valuation, we need to be mindful of the fact that the valuer is having the right credentials. We need to evaluate the methods, the models which are being applied by the valuer. What are the different assumptions which are being used as a part of my audit procedure, which I was always required to perform as a part of my auditing standard. Here, I think one of the important aspects I would like to draw attention to is that if last year company has performed a valuation, just go through the valuation report to find out whether the valuer is registered or not. In case if the company is engaged with a valuer which is not registered under the Companies Act, then I think it is important that we have a dialogue with the client to say there's a need to change the valuer, because now the requirement is that the valuation need to be performed as a part of the by the registered valuer. So if you just go through your work papers of the last year and see if the valuer is registered or not, and then have that conversation with the client accordingly. Moving on to the third aspect, which is Benami property. So this is a new reporting requirement. Here, what is expected to be reported is auditor need to identify whether there are any proceedings which are initiated or pending against the company under Prohibition of Benami Properties Act. Okay, and if there are such proceedings which are in progress, then whether company has made adequate disclosure in the financial statements about that proceeding. So this is a factual reporting about the proceedings under Benami Prohibition of Benami Properties Act. Now let us try and understand what is Benami property. As per the definition in the Act, Benami property is something where the property is held or transferred in favor of person A, but the consideration is paid by person B. So, and the property is held for the immediate or a future benefit of the person who is paying the consideration. So let us say there's a beneficial owner which pays the consideration, and the property is held in by the beneficial owner for his future benefit, and there is just a benamidar which is just having a name as an owner of that property, but is not a real beneficiary of that property. So in such case, the person in whose name the property is registered is a benamidar, and the person who is the beneficiary is called as beneficial owner of that property. So in case if a proceedings are initiated against the company that you are auditing as the benamidar, means he is holding the property without paying consideration for it, without being entitled to the future benefit of it, or maybe he's not aware of the fact that the property is being held in the name of that company, then the company becomes the benamidar, and hence such proceedings are required to be reported in CARO report. That is one important requirement that is there. So how do you really identify that any such proceedings are being initiated against the company? Well, you would perform procedures around making inquiries with the management, going through the litigation logs, having a discussion with the internal legal counsel whether any such proceedings are initiated, review the minutes of the board meetings, audit committee meetings, risk management committee meeting, etc., to identify whether any proceedings of this nature has been initiated against the company, and if so, whether the details have been properly disclosed in the financial statements. This report, I mean, normally this is very rare to happen, and if let us say there are situations where company has received notices as holding a benami property, then on a larger scale we need to be mindful of its implications around what is the governance around, governance of the company. Are there any misstatements that are there? Is there a wider reporting implications from fraud perspective, etc.? And those all need to be borne in mind as a part of our reporting under this clause. There could be a situation that while as of 31st March, there were no proceedings initiated against the company, but let us say by the time you sign off your audit report in maybe July or August of the following financial year, the notices are being issued or proceedings are being initiated against the company. Even those cases will need to be covered as a part of the reporting on this clause. So you need to see notices received during the financial year plus till the date when the audit report was signed. Till that period, if there are any proceedings, then those needs to be captured as a part of this reporting. Here, there could be an implementation challenge in the sense that how do you really ensure completeness and accuracy of the proceedings that are being pending as a company? And as I said, we need to perform certain procedures to ensure that we have covered all sources of information to ensure that the required notices or proceedings are being is known to the auditor, and then those are being properly disclosed in the financial statements. So these are three key changes which is coming to property planning equipment. Benami property is a new one. There's a revaluation, which is again a new reporting, and title deeds of immovable property is an enhanced reporting. So this covers the property planning equipment section. Now we'll move to second section, which is inventories. So previously in CARO 2016, as an auditor, we were required to report whether company has conducted physical verification at a reasonable interval, and if there are any material discrepancies, whether those are being properly dealt with by the company. So this was the reporting requirement in 2016. When it comes to 2020, the reporting has been enhanced, not only to say that the physical verification was conducted at the reasonable intervals, but also we need to specifically comment on the coverage and the procedures that are performed as a part of the physical verification. So the reporting levels have enhanced compared to CARO 2016. So there is a one change that has happened. We need to comment upon coverage as well as the procedure. Now, when I look at this new requirement and compare that with our responsibilities under the auditing standard, we were always required to evaluate whether physical verification is being performed by the company to obtain a reasonable coverage, right? In terms of, let us say, I have 10 locations, have I covered a substantial portion of the locations? Have I covered different classes of inventory at least once in a year? And also, we were also required to evaluate the procedure in the sense, are there any sufficient instructions being issued to the account team? There are proper cutoff procedures being followed. The results have been properly compiled and the differences are adjusted, etc. So those, in any case, we were required to perform as a part of our auditing standard, but those are not required to be specifically commented upon previously. But now with CARO 2020, auditor is specifically required to confirm that he has looked at it and he's fine with it in terms of coverage and the procedures. So this is a change which is there in respect of inventory of physical verification. And as I said, we were in any case performing these procedures before as a part of our responsibility for auditing. So moving on to the next one. This is additional, I would say, enhanced reporting requirement whereby a quantitative threshold of 10% is now prescribed for reporting of discrepancy. Earlier, as I said, we were only required to report if material discrepancy in terms of amounts were noted and were adjusted or not adjusted in the books of accounts. Now that materiality threshold has been done away with, and auditors are required to report whether there is any discrepancy that is noted of 10% or more in aggregate for each class of the inventory. Right now, when I look at class would mean raw material, packing material, WIP, finished goods, traded goods, etc. Because those are the classes which are defined in the financial statements under the inventory schedule of the company. So you don't have to look at the materiality, but just need to look at the 10% threshold, which is there as a part of the reporting. So that is one change that has happened. Second is that this 10% threshold needs to be applied on a net basis after adjusting the shortage or excess which is identified for the respective category, and not on the quantity. So if you, let us say, found that you have a difference of 5 crores of an inventory of 100 crores, you would take the difference of 5 crores as numerator. You will divide that by the book value of inventory of 100 crores. And if it is, let us say, 5%, then you don't need to report whether company has actually adjusted those differences or not adjusted differences. As against this, if the difference was, let us say, 12 crores, then of course it is more than 10% for a particular class of inventory, and hence you would need to then adjust, report that whether those are being properly dealt with by the company. So just to summarize, the change is from material discrepancy to 10% threshold, and it requires you to evaluate for each class of the inventory, as opposed to on the basket basis, which was there previously. What are some of the challenges that we may face while reporting under this clause? So first one is, there could be a situation that a company having a raw material which is spread geographically at 5 to 6 different locations, and counts are happening at a different point in time. How do you really evaluate the discrepancies at this location? Because same class of inventory getting stored at multiple locations, counted at a different point in time. How do you really look at it? So here I think you need to look at what frequency that class of inventory is being counted. So let us say company has a policy to conduct a physical verification of raw material once in a month at different locations. So what you need to do is, on a monthly basis, aggregate the results of physical verification for each of those locations together to find out what are the discrepancy in each of the locations, what is the total value of my raw material inventory, and then compute the difference for the purpose of reporting under this clause. So this could be one of the mechanisms that can be applied for multi-location organization. Second challenge will be in certain categories of companies, detailed records of receipts and issues may not be maintained, and the physical verification would be determined based on, the closing inventory will be determined based on the physical verification of the inventory. In such case, it becomes very difficult to compare what was the book record, what was the physical outcome, and then what is the discrepancy. In such case, auditor can ask for a reconciliation of opening, purchases, closing, and then deduce and then derive the amount of closing inventory as per books and compare that the physical verification. If that is not possible, then in our report we need to mention that company did not maintain adequate records in terms of receipts and issues, and hence discrepancy, whether it is more than 10% or not, it cannot be determined by the auditor. So these are the two practical challenges which we face as a part of reporting under this clause. Moving on to next slide. So this is a new requirement. This requirement is applicable in case of companies which has obtained a working capital sanction limit from banks or financial institutions for a value exceeding 5 crores. Okay. Now, what is important is the sanction would need to be obtained on the basis of security of current assets. If the company has obtained such a sanction of more than 5 crores, then what we need to report? We need to report on one aspect is about whether the quarterly returns and the statement that are being filed by the company are those in agreement with the books of accounts, right? Because as a part of the loan agreement, company would need to file details about debtors, inventories, receivables, payables, etc. And those are normally derived basis the books of accounts. But there have been cases where certain companies have been filing wrong information as a part of those quarterly returns, and because of which those really do not agree with the books of accounts. So when you compare the information and find that there's a discrepancy, then those discrepancies needs to be reported as a part of CARO report. So here there are certain important consideration in case if the sanction limit is based on other than current assets, it could be fixed asset or it could be for any other security, then reporting under this clause is not applicable. It is only restricted to security against current assets. Secondly, we need to be mindful of that the threshold here is sanctioned working capital. So let us say the sanctioned working capital is 5 crores, but the company has actually drawn 3 crores during the year. But still the reporting will be required irrespective of whether what is the actual drawdown which the company has done as a part of its facility. That is second important requirement. Third is you need to look at the working capital facility for all the banks put together. So let us say I have a relationship with bank A where I have a sanction of 1 crore. There's bank B where I have a sanction of 3 crores and bank C where I have a sanction of maybe another 3 crores. If the sanction limit of all these three banks put together exceeds 5 crores, then the reporting of this clause will get triggered and auditor will need to then obtain those quarterly returns and then compare whether those are in alignment with the books of accounts. So important things when we look at the applicability, sanction plus it should be basis the current assets of the company. And once you find the differences, there could be differences which are very small. It could be on account of the timing gap between certain updates that has happened subsequently. And if those are very small, auditor can really exercise a judgment in terms of materiality and the professional judgment to evaluate whether those discrepancies are really required to be reported as a part of this clause. So that judgment is still there. But having said that, this is more of a factual reporting. And if there are differences, it is important that those are reported. Another important aspect is certain companies, because of the nature of arrangement with the bank, may file monthly returns of the statements with the bank. But as a part of our audit responsibility, we just need to evaluate the quarterly returns and not the monthly returns, even though as a part of their arrangement, they may be filing the monthly returns. So just restrict ourselves in terms of quarterly reports that are being filed by the company for the purpose of reporting under this clause. Moving on to the next section, which is on investment guarantee, security, and loans and advances. This is one of the very, I would say, very detailed clause, which is applicable. There are about 6 sub clauses where there are different types of reporting. And when I look at some of these sub clauses, it appears that now there's a growing focus among the regulatory authorities to identify what are the cases where company has given loan to promoters, cases of siphoning of funds, loans and advances which are given to group companies for the purpose of siphoning of the money, etc. So the objective of enhancing this clause is to track what is the manner in which company is making its investments, loans, guarantee and security, and are those in the interest of the company. So that is one of the important change that has come. And there are about 6 sub clauses, and we'll go and understand each one of these. But before we dive further into each of these clauses, let us understand what has changed compared to CARO 2016. So previously, if you remember, this clause was only restricted to loans given by the company, and there were certain specific requirement about whether the repayment is regular, whether those loans are prejudicial to the interest of the company, and otherwise. Okay. Now the scope of reporting has significantly increased to cover not only loans but also advances in the nature of loans, which are normally given. While those are loans, but those are not characterized as loans. That is one. It also covers investments, it covers guarantee, it covers security. So the scope has significantly increased from loans to investments, guarantee, security. That is one big change that has happened. And secondly, earlier the scope of reporting was only restricted to loans granted to parties, firms, entities which are covered under section 189 of the Act. Okay, so it was only restricted to those specific set of parties which are covered under 189. But now the scope of reporting has expanded not only to those parties but to any other party. So if the party which was previously not covered by 189 and was not reported as a part of your CARO 2016 report, those all would get covered and will get reported as a part of CARO 2020. So there are 2 enhancements. One is the nature of transaction has undergone a change, and secondly, the coverage in terms of parties also significantly undergone a change compared to CARO 2016. Now let us try and understand each clause under this section 3. So if you look at my screen pointer, first reporting requirement is that whether the company has granted any loans or advances in the nature of loans, or has given guarantee, or has provided any security to any entity, then the aggregate amount of such loans, advances, security, guarantee needs to be reported. That is one. And that needs to be broken up into 2 sections. One, loans, guarantee, security given to associates, joint ventures, subsidiary, and loans, guarantee, security given to other than subsidiary, associate, joint ventures. So that the reader can understand, okay, these are the loans given to group companies. These are the loans given to other than group companies. So that is one important requirement that has come. Now, what do you mean by the word advance in the nature of loan? Because it is very difficult to identify what type of advances would become advances in the nature of loan. And there's no definite guidance in CARO 2020. But when you look at the guidance note provides an indicative guidelines to say that, let us say you have paid an advance to your subsidiary company of, that is, 100 crores for purchase of material, which normally on an annual basis will be only 10 crores. Okay, so this is just a means to provide 90 crores of advance or a loan to a subsidiary company, though the purchase contract would only require or warrant an advance of 10 crores. If that is the case, then this would be in the nature of advances in the nature of loan. That is one example. Second example is that if, let us say, my purchase terms are such that I get the material within 30 days and then I make the payment within 45 days. So maximum exposure should be about 45 days from the date of purchase. But if the amount or advance is given, say, let us say for 1 year, which is substantially larger compared to the normal trade practices which are applicable to that sort of industry or that sort of company, then even that term will be treated as a term for which loan has been given. So you need to be mindful of what are the normal trade practices, the purpose for which the loan is given, the period for which the loan is given, and thirdly, the amount for which the loan is given. So if I put all these three into a basket and then evaluate with the normal trade practices, if it is significantly in excess, then it becomes it takes a color of advances in the nature of loan. So all those categories will now be required to be covered as a part of CARO 2020, which was not there and not expected to be covered as a part of CARO 2016. So this has been one big change that has happened in terms of reporting under clause 3. Second, here, moving on to the next reporting clause, which is clause B. Here we need to evaluate whether the investments, guarantee, security, loans and advances in the nature of loan, whether those are prejudicial to the interest of the company. So earlier there was similar reporting clause, but it was only restricted to loans, but now it is for investment, guarantees, security, etc. For the purpose of reporting under this clause, we need to be evaluating factors like what are the terms at which the loans is given, what is the financial credibility of the borrower or the investee company, is there a valuation being performed on the basis of which the investment is being made, what is the rate of interest, type of security, etc. So those are some of the things that we as an auditor would need to evaluate for the purpose of getting comfortable that the amount of investments, the loans, the guarantee of the security are not prejudicial to the interest of the company. And on that basis, we can report our judgment, and exercise our judgment and report on that basis. Generally, in case of large companies which has complex group structures, subsidiaries, associates, joint ventures, fellow subsidiaries, various types of different transactions, it can become very challenging for us to evaluate whether each of those transactions around loans, guarantees, security, investments are made in the interest of the company. So that may require significant judgment and also could be complex because normally the volume would be high, the value would be significant, and the number of transactions would also be higher for in such large companies. So it will require involvement of significant judgment and also could be complicated in terms of its evaluation. Moving on to next sub-clause. So there are two sub-clause on this slides, clause C and clause D. There is not too much change in respect of this compared to CARO 2016. So here what we need to report is whether in case of loans, where there's a stipulation about principal payment and the payment of interest which is there in the contract with the parties, with the borrower, whether such repayments are regular, that is one reporting. And secondly, whether if there's an overdue, let us say the amount was due to be paid by December 2021, but it has not been paid. In case there's an overdue more than 90 days, then whether the company has taken reasonable steps to recover that amount. So this requirement was there in CARO 2016, so not much change. But what you need to do is we need to be mindful of what are the steps which are being taken by the company to recover this amount. It could be correspondences with the parties, obtaining additional security from the parties. Company can issue a legal notice to the party for the purpose of recovering the principal and the interest. Those need to be evaluated for the purpose of reporting on this clause. And also it is very important that it is not always necessary that company has always need to file a legal notice for the purpose of recovery, so long as the company has taken reasonable effort looking at the amount involved, the time delays, subsequent collection of the amount, etc. If those have been there, company has kind of done correspondences, etc. Those should also be sufficient to comment that company has taken reasonable steps for recovery of principal and interest. It need not always be that company need to file a legal notice against the borrower. So it will require an exercise of judgment depending on the size of the loan, the delay, the profile of the borrower, etc., to form a view that company has taken a reasonable steps for recovery of this amount or not. Item number 5 is a new reporting requirement. Now this covers cases of evergreening. Now just to brief you, what does evergreening mean? So evergreening is normally prevalent in case of banking and finance sector, whereby a fresh loan is given to a borrower to hide or to mask a default by that company or by that borrower, so that what happens is the borrower will take the new loan and pay the old loan so that it does not get reflected into the old loan balances. Right? So this is just to mask the aging profile of the borrower as opposed to getting the money back. That is normally the case in case of banking and finance sector. So here the reporting is that if there's a loan which a company has given a loan and the loan has fallen due during the year, whether the loan has been renewed by the company A or extended by the company, or any fresh loan is given to settle the overdue of the existing loan to the same party. And if there are any such transaction, then we need to report what is the aggregate value of such transactions and what is the proportion of such transactions to the overall loans and advances granted by the company during the year. So you need to be mindful of two things. One, whether there are any instances during the year where a loan was due to be paid by the company, by the borrower, but it has not been paid, and in lieu of that, company has granted further time for repayment, for renewal, or a fresh loan has been given to settle the old loan. And if there are such transactions, then those are need to be reported as a part of this clause. So a new clause, an important clause to be mindful of. Moving on to the next section, this is again a new clause, new reporting, and this is applicable in situation where company has given loans which are repayable on demand or without specifying any specific terms or a period of repayment. So if there are any loans which are payable on demand, there are no fixed terms which are specified, it is not very clear when they will make the payment, not make the payment, etc. Then the aggregate amount of such loans and advances which are payable on demand or without any specific terms needs to be reported. We also need to report whether any such loans are given to promoters, related parties, which are defined under the Companies Act, and if so, what is the proportion of such loans to the overall loans which are granted by the company. So again, an important element, a qualitative aspect of the reporting, that if a loan is given which is repayable on demand or without any terms, we need to then report whether those are being given to promoters, etc. So to arrest the siphoning of the fund, diversion of the fund, etc. And those gets reported as a part of this clause. Here we would need to review the terms of arrangement with parties just to see whether the terms are specified, and if not, then those will all get reported as a part of this clause. So these were about 6 clauses in investment, security and guarantee. These are all, as I said, substantial changes requiring auditor to comment upon various aspects, qualitative aspects of investment, guarantee and security, evergreening, loans payable on demand, is there a repayment which is regular, not regular, etc. So a substantial change and very important to be mindful of so far as our CARO 2020 is concerned. Moving on to the next section, which is on the statutory dues. So here previously there were 2 clauses. One clause A related to the fact that is there a delay in repayment of statutory dues, and if so, we were supposed to make comment whether company is regular in payment of statutory dues, And if there were any overdue outstanding more than 6 months, we were required to report the amount of such overdue outstanding. So clause A, there's no change between CARO 2016, CARO 2020, but there's a significant change when it comes to CARO clause B. Now, previously in CARO 2016, the reporting under clause B was only restricted to certain specific laws like income tax, sales tax, custom duty, excise duty, GST, etc. Okay. Now, and if there was a disputed due in respect to only these requirements or these laws, those were reported under clause B. But now the scope has significantly increased to report disputed dues not only in respect of these specific laws, but in respect of any material law. So for example, if there's a dispute for provident fund dues, those will get now reported under clause B. If there's a dispute relating to, let us say, entry tax, those will now get reported under clause B. So the scope of reporting has significantly increased in terms of clause B under CARO 2020 as compared to CARO 16. And if you look at large companies which has operation in almost every state, different levies, state levies, central levies, compilation of this information of disputed dues for such large companies could be a challenging thing, because now all of the regulation needs to be evaluated from a reporting perspective. So that is one thing that we need to be mindful of. Secondly, certain important considerations, like if let us say the demand has been stayed by the authority, or a matter has been decided in favor of the company by lower authorities, but the department has gone into appeal, those are the situations will be treated as disputed dues for the purpose of this reporting. So you have to call it out as disputed and then ensure that the information is getting disclosed as a part of clause B. Certain other examples, like company has made a voluntary settlement under, let us say, dispute resolution scheme, or the matter is set aside, there's no more demand which is prevailing, then all these items will be not treated as disputed dues. Those will be, if there's a demand and company has actually accepted the demand, then those will get reported as a part of undisputed statutory dues under clause A. So we need to be mindful of what is the status of the matter, where the company is in terms of the filing, or in terms of the appellate tribunal or authorities, and the level at which those are present. And then if based on the outcome, if you believe that the matter is disputed, then it gets reported at clause B. If it is not disputed, it gets reported at clause A. So this is again a wider increase in terms of reporting responsibilities so far as statutory dues is concerned. Moving on to clause 8. So here, this is a new reporting. This reporting is applicable in situation where certain transactions were not recorded in the books of accounts by the company, but subsequently, as a part of the assessment under Income Tax Act, company has voluntarily offered those transactions as income. Okay, so the transactions is not recorded in the books of accounts, but voluntarily offered for tax. Those are the cases which will get reported as unrecorded income as a part of this clause. And here, if there are such instances, then auditor need to report whether subsequently, after the declaration is being made by the tax authorities, whether the company has recorded those income as a part of books of accounts. Okay, so one is the factual aspect of it, that company has voluntarily made a declaration of income, and secondly, recording that item in the books of accounts. So this is what the new reporting requirement is. Here, it is important to note that this reporting requirement is only applicable in case company makes a voluntary declaration of income as a part of its tax assessment. Let us say there's a demand which is being raised by the tax authorities, and company is actually filing or disputing that demand. Those cases will not be treated as undisclosed income and would not get reported as a part of this clause. Only voluntary submission or acceptances of income which were previously not disclosed in the books of accounts will get covered as a part of this clause. So here, I think what we need to do is we need to kind of go through the tax assessments which are done what are the submissions which are being made by the company, are there any declaration or acceptances of income which are being made by the company as a part of search and seizure operations, etc. And then those will get covered as a part of this reporting. You also need to be mindful when such instances are occurred and company has made a voluntary declaration of income which was not recorded in the books of accounts. What is the impact of that from prior period item perspective under accounting standard? What is the impact on restatement of the financial statements perspective? Because those incomes should have been appropriately booked in the respective years, but were not recorded in the respective years. So that is the important aspect. You also need to be mindful of what is the impact on processes and controls, because if there are such transactions where company has not recorded income in its books of accounts and then subsequently was offered to tax, then of course the control and the governance culture of that company may not be adequate, and then auditor will need to accordingly report those aspects as a part of our internal financial control, as well as evaluate the reporting implications on the main in the main audit report. So very important clause. And how do you link this reporting with reporting on internal financial controls and also on the financial statements of the company as a part of your procedures? Moving on to clause 9, this again similar to the reporting responsibilities for investment has undergone a significant change. This clause 9 also has about 6 subclauses, and some of these are new reporting, and the objective is again to identify qualitative aspects of how company has raised the funds from banks, financial institution and other lenders, and how it has deployed those funds for the purpose of its operation. And are there any instances of, I would say, defaults, siphoning of funds, funds used not for the purpose for which it was obtained, etc. So those are all qualitative information which, as a part of this clause 9, auditor is required to evaluate. So there are, as I said, 6 subclauses, and we would go through each of these in detail. So the first one is that when the company has taken borrowing, whether they have defaulted in respect of repayment of loan, borrowing, or interest in respect of that loan. So if company has defaulted, then we need to mention the period of default, the amount of default, etc. When you compare this with CARO 2016, previously only borrowings from banks, financial institutions, government and debenture holders were covered as a part of this clause. But now any borrowing, whether it is from a private individual, whether it is from a company, whether it is from any other party, so all will get covered as a part of this reporting. So scope has increased not only for banks, financial institutions, debenture holders and government, but for all the parties. That is one important change that has happened. And the details need to be reported as a part of this clause. Secondly, when I look at the reporting, public deposits, and if there's a default, those are not covered under this clause because there's a separate clause under for reporting of default for public deposits. So those will not get covered as a part of this clause. That is one. Secondly, if company has issued a preferential capital, but from an index point of view, those are classified as borrowing. Those are also not covered as a part of this clause because preferential capital for the purpose of this reporting is treated as equity share capital and hence not covered for the purpose of this reporting. So if there's any default either for public deposit or for preferential capital, no reporting is required in respect of this in this clause. There could be a situation where company has defaulted in repayment of loan and has subsequently made an application for rescheduling, restructuring of the loan. Those cases, auditor would need to report as a part of this clause because while there's a restructuring, but the company has defaulted in repayment of its debt from principal and interest perspective, and those will get reported as a part of this clause. Now, if there's a default as of the balance sheet date, but subsequently the banker has waived off or has restructured the loan, we may comment in the report that subsequently there has been a restructuring and company has been granted additional time for the purpose of repayment of this amount. So this is an additional report, consideration that we need to bear in mind while performing or reporting as a part of this clause. So this was on repayment, delay repayment of borrowing. Moving on to the next one. Next clause is a factual reporting. Here we just need to comment upon whether company is declared as a willful defaulter by any bank, financial institution, or other lender. If company has been declared as a willful defaulter, you need to mention that fact that yes, this company has been declared as a willful defaulter, and then report accordingly. Now, generally, willful defaulters are defined by the RBI circular as someone who has defaulted in repayment of its principal and interest in situation where he was capable of honoring the commitment, but he did not honor that commitment. So those will be the examples of willful defaulter. There are other examples where company has defaulted in repayment of dues of principal and interest, uh, and the funds were actually utilized for the purpose other than for which the loan was granted, or there was a siphoning of funds, or the loans are being used for some other purposes for which it was used. So these are some of the examples of willful defaulter. For the purpose of identifying whether the company has been declared as a willful defaulter, what we need to do is, as a part of our bank confirmation procedures, we can send the confirmation to the bank to confirm whether, as per their records, this company on which we are auditing is declared as a willful defaulter. We can also go through RBI website, some of the other reports like CIBIL, CIRC database, etc. Information in the public domain, which will help us to evaluate whether a company is actually identified or declared as a willful defaulter or not. And based on these procedures, if the answer is yes, we report that factually here. If the answer is no, we report the fact that the company is not declared as a willful defaulter. So this is just a factual reporting based on the audit procedure that we perform. Third is around application of the term loan. So this reporting, when I compare with CARO 2016, the new reporting, but I think there was a similar clause which was applicable in the earlier CARO, maybe 2013 or 2015, whereby we were required to report whether the term loans which are raised by the company are applied for the purposes for which it is being raised. And if there is an exception, in the sense that the term loans are not raised or not applied for the purpose for which it is raised, then we need to report the amount, the purpose for which it is diverted, and the reasons behind the same. So this is again a factual reporting that is required to be considered for the purposes of reporting. Typically, term loans would be for a certain tenure, normally ranging from 3 to 5 years, and as a part of the conditions of the grant of the sanction of the loan, there will be specific purpose for which this loan is granted. So when we perform work around this clause, we need to review the sanction letter to see what was the specific purpose for which the loan was granted. It could be for projects, it could be for acquisitions, it could be for purchase of plant and machinery, etc. And if the amount is being used for that purpose, then there's no adverse reporting. But if it is not used, then there will be an adverse reporting under this clause. Here, I think what is more important is one-to-one nexus is not very important. I mean, you don't have to have that, okay, the money has come in this separate bank account and from there it has been paid for a purpose. It is not required, so long as amount, even if the amount is there in the common bank account and it is used for multiple purposes, so long as the total amount is deployed for the specific purpose for which it is used, for which it is sanctioned, then it should be sufficient compliance from the reporting perspective. There could be a situation where company has received, let's say, 100 crores of sanction, but it is not able to expend that money because of certain reasons. And in order to reduce the cost of interest, they have temporarily deployed that fund into a bank account or maybe as a fixed deposit. Right? Those are the instances, those would not be treated an exception because the ultimate objective of the company was to use that money for the specific purpose, and it was only for the transitory period. It could not be deployed, and it was used for fixed deposit or any other short-term investments. Those will not be treated as an exception for the purpose of this clause. Here, one important aspect to consider is when it comes to Ind AS, certain loans, because of the way the contractual arrangement is, can be classified partly as equity, partly as debt. Okay, so let us say a company has received 100 crores loan, and out of which 50 crores is classified as equity because conversion features, repayment schedule, etc., and only 50 crores is classified as borrowing. In such case, for the purpose of reporting under this clause, we need to take the application of the entire 100 crores and not the 50 crores which is classified as debt and 50 crores as equity. So we need to see the application of entire 100 crores as opposed to just 50 crores, which is classified from an accounting perspective as borrowing. Moving on to next clause 9. This again is more to do with a qualitative aspect and a new reporting. It deals with the fact that whether short-term funds have been applied for long-term purposes, and if so, the details need to be provided. So this again, while from 2060 perspective, it is a new reporting, but there was a similar reporting which was there previously in CARO, and we were required to evaluate whether the short-term funds raised are applied for long-term purposes. This needs to be evaluated from a overall financial position perspective. So if I have a short-term sources of funds like borrowing, current borrowings, and I have a short-term application, so long as my short-term funds are more than my short-term application, so long as my short-term funds are actually lesser than my short-term application, then it will be mean that the short-term funds are applied for long-term purposes. And if I have enough long-term sources of funds and long-term application is lesser than long-term sources of funds, then the reporting under this clause would not be applicable. So we need to look at it on an overall financial statement position as opposed to individual sources and application for the purpose of this reporting. Typically, if there's a current ratio which is less than 1, which would mean that those funds are being actually utilized for long-term purposes. And we need to look at those examples and the fund flow statement to see whether really short-term funds have been used for long-term purposes, and if so, the details need to be provided as a part of this clause. The next item around borrowing is reporting on whether company has obtained any funds from the banks, and those are meant to be used for the purpose of meeting the obligations of subsidiary, associate, and joint venture. Okay. Now, if a parent company makes a borrowing and then uses those money to meet the obligation of subsidiary, associate, or joint ventures, those are required to be reported as a part of this clause. This again, as I said, is a factual reporting. And once you obtain the details of funds raised and how it is being deployed, it will be clear that are those funds really used for the purpose of meeting the obligation of subsidiary, associate, and joint ventures. In case of companies which has a good sufficient cash flows from operations, positive inflows from investing activities, inflows from equity share capital, etc., those are the companies which are less likely to be impacted because of under this clause, because they will be able to demonstrate that whatever application they have made to meet the obligations of subsidiary, associate, joint ventures, those are not out of the borrowed funds, but out of its own generation or from equity share capital. So we need to be mindful of comparing what is the source of funds vis-a-vis the application and see whether any reporting will get triggered as a part of this clause. Moving on to the last section on clause 9. So it deals with a situation where company has raised funds based on the pledge of the securities held in subsidiary, associate, joint ventures. So if company has during the year raised any funds based on those pledge of securities, then the details in respect of such loans needs to be mentioned. That is one. And secondly, we also need to mention whether company has defaulted in repayment of such loan. Okay. Here we don't need to provide the details because the details of default are already getting covered as a part of clause A. We just need to say whether the company has defaulted, and if so, then the details are reported at clause A. This is only restricted to the case where loans are raised based on the pledge of securities and not otherwise. So when you actually read the term sheet of the loan, and if the security offered is the investments of subsidiary, associate, joint ventures, those will be the matters which will get reported as a part of this clause and not otherwise. Here what is important is for the purpose of reporting, we need to look at the loans which are taken during the year, loans which were taken in previous years based on the security, but those are outstanding as of the balance sheet date. Those are not required to be covered as a part of this reporting. So that is one important aspect that we need to bear in mind for the purpose of this reporting. So these were, as I said, these were important clauses relating to repayment and application of borrowing. Again, very qualitative. Objective is to understand how company is using the funds that are taken as a part of the borrowing, and are those being used to siphoning off for other purposes, are there any indications of liquidity, etc., which company is facing because of using the short-term funds for long-term purposes. So those will all be kind of brought out by reporting under this clause. Moving on to clause 11, this is, as I said, is an enhanced reporting. Last in CARO 2016, we were required to report whether there has been any fraud noticed or reported by or against the company by its employees or officers of the company. So previously, the scope of reporting was only restricted to fraud committed on the company by officers and employees. But now the scope of reporting has increased to not only fraud committed by employees and officers, but also by other parties like vendors, customers, employees, third parties. So all this will get reported as a part of this clause now. So this is again a change that has happened. Secondly, as a part of our audit, we need to consider, of course, if the frauds are very small, not material, we can evaluate basis materiality. While performing the work around other clauses in CARO, like, are there any discrepancies reported in the returns which have been submitted to the bankers? Are there any unrecorded income which are being disclosed to the tax authorities? Those can be evaluated and linked as a part of this clause to say that, okay, if there was an undisclosed income, was there a fraud which was being committed on the company or by the company? And if so, those will get to be reported as a part of this clause. So important element is we need to perform our normal audit procedures as a part of this reporting. And then all frauds, whether it is by employees or officers, will get reported as a part of this clause. This is a new reporting here. As an auditor, we are required to report whether any report under section 143.12 has been filed by the auditors with the central government. So this is, as I said, just there's no additional procedure that we need to perform. If auditor has identified any fraud exceeding 1 crore as a part of section 143, it is required to make a filing under ADT form 4 to the central government specifying the details of those fraud which are being noted. And if any such filing has been made, previously it was not very clear by reading the report that any such filing has been done. But now this reporting has brought in CARO to specifically comment that, okay, if there's any report which is being submitted to the central government, the factual aspect of that needs to be reported as a part of CARO. That is one change that has happened. And we also need to be mindful that this form ADT is not only required to be filed by the statutory auditors, but let us say if the cost auditor or the secretarial auditor has also found out any fraud against the company by the company of exceeding 1 crore, then that also needs to be covered as a part of a CARO report. So while I as a statutory auditor may not have filed ADT form, but if it is filed by cost auditor or secretarial auditor, even those will get covered as a part of this reporting requirement. Lastly, on the fraud, there's a specific requirement to say that whether the whistleblower matters or whistleblower complaints which have been received by the company during the year has been considered by the auditor. Now, from a scope perspective, there's no change because as a part of our audit, we were always required to evaluate whistleblower matters which are being reported on hotlines, whistleblower lines, etc., and then evaluate the audit implication of those. But now, specifically under CARO, we are required to make a positive affirmation to say that, yes, we have considered those matters as a part of my audit. So no change in the scope, only specific reporting that is required. Here, the requirement to maintain the vigil mechanism is only applicable to certain categories of companies like listed companies or companies which are of certain threshold. And if let us say a vigil mechanism is not required to be maintained, then company may at an option maintain that vigil mechanism. And if there is such vigil mechanism maintained by the company, then the auditor need to obtain the details of complaints that are lodged or received as a part of that mechanism. If there is no such mechanism that is being maintained, what auditor can do is they can make inquiries with board of directors, other management, maybe secretarial team, etc., to identify whether there are any matters which they are aware, and if so, those will get reported as a part of this clause. Here, what is important is in case of multinational companies, you would have a whistleblower mechanism which is there maintained at the group level, and all the matters will get reported directly at the group hotline number. So if companies like multinational companies are having such mechanism, then auditor would need to obtain those details from the custodian of those whistleblower matters and then evaluate those matters as a part of his audit procedures. And if there are no such vigil mechanism being maintained, then of course, auditor would make those inquiries to satisfy that there are no whistleblower complaints that have been received during the year by the company. So again, a factual reporting about receiving of whistleblower matters around fraud. This reporting, which is on clause 12, is applicable more to do with Nidhi company. So if Nidhi company has made a default in repayment of deposits or interest, then those will need to be reported as a part of the CARO report. Normally, this is only restricted to Nidhi company, and only defaults are required to be reported as a part of this clause. Moving on to clause 14, this reporting is required on the internal audit function of the company. So there are two reporting responsibilities. One is we need to comment whether company has internal audit system which is commensurate with the size and nature of the business, A. And secondly, whether the reports of the internal auditor are being considered by the statutory auditors. Okay. So these are all, I would say, first one is a qualitative assessment whereby I need to form a view whether it is commensurate, and secondly, I'm required to evaluate the reports submitted by the statutory auditor, by the internal auditors. Here, there are certain important aspects to consider. One is not for all companies, internal audit is mandatory because there are certain thresholds which are prescribed under section 138. And in case of our company where I'm reporting on, internal audit is not applicable, then company may voluntarily have an internal audit function. If they have it, we need to report that company has internal audit system commensurate with size and the nature of the business, and we have considered the reports. If company really do not have that internal audit function and nor it is required to have an internal audit function, then auditor will need to factually report that company is not required to have an internal audit system as part of Companies Act 2013. If company is having an internal audit function, then we need to evaluate what is the size of the company, the nature of its business, how geographically dispersed the company is, and what is the size of the internal audit department. Now, company can have its own in-house department, or it can outsource the work to a professional firm of chartered accountants or any other professional for performing internal audit work. We need to evaluate what is the composition of the department, what is the qualification of the people who are actually performing the internal audit work, the experience, the reporting lines. And if it is a firm, then we need to see what is the level of experience of that professional firm, the partner, the manager working on that job, etc., to evaluate whether the internal system is commensurate with the size and the nature of the business. We also need to look at what is the periodicity with which the internal audit is getting conducted. Is it quarterly, is it monthly, or less frequently, right? And based on the nature of the company, we can form a view that whether it is commensurate with the size of the company and nature of its business. Here, what is important and certain things to be borne in mind is that in case of a multinational companies which has small subsidiaries in India, typically the scope and the coverage of internal audit is done and monitored with the group companies or the group management, because for them, they need to look at various territories across the globe to evaluate internal audit. And in such situations, if the subsidiary is very small, the group management may not really scope in the Indian subsidiary, or maybe scope in at a very less frequent interval, like once in 3 years, once in 2 years. So here, what is important is if the company is covered and is required to have an internal audit system, we need to have a conversation with the client and also with the group management to say that from an India standpoint, internal audit is mandatory, and you need to have a proper coverage of internal audit so far as Indian subsidiary is concerned, as opposed to evaluating the coverage from a global perspective. So that is one important element that we need to have in mind while evaluating the coverage and sufficiency of internal audit system. Also, what is more important is the timing of getting the internal audit report. Sometimes because of the timing the company on which we are auditing, we have to report, let's say, by June, but the internal audit is still in progress and the report is expected by, let us say, September. So here we need to be careful of aligning the timing of the internal report much in advance of our reporting deadline, so that we are able to get those reports and are able to evaluate those as a part of our audit work. So maybe time to engage with the client that now there's a specific requirement in CARO that we need to specifically mention this fact, and hence the timing of internal audit need to be aligned properly before we sign off on the our statutory audit report in case of that company. So there were two reporting clause on internal audit. I will move to next clause, which is cash losses. Now this is again a qualitative requirement, a new requirement, whereby we need to report factually whether company has incurred cash losses in the current financial year and also in the immediately preceding financial year. So if in any of the 2 years there are cash losses, then we need to report the amount of such cash losses. Now, cash losses for the purpose of this reporting is different from what is reported in the cash flow statement. So there's a specific mechanism which is prescribed in the guidance note, and it is separate for India's companies and other than India's companies. So if I look at India's companies, what you need to do is you need to consider the profit after tax other than comprehensive income and adjust that profit for non-cash items such as depreciation, impairment, fair value changes, gain or loss, deferred tax, because it is a non-cash item, to arrive at the cash profit from profit and loss account. Then you also need to take into account what is getting recorded as a part of other comprehensive income. So if, let us say, there are cash realized profits which are sitting as a part of other comprehensive income, then that also needs to be considered for the purpose of arriving at cash profits or cash losses for the purpose of this clause. So suppose I am following a hedge accounting and my hedge instrument have matured and the gain or loss on those hedge instruments are sitting as a part of other comprehensive income. But since the hedged item is yet to occur, which is highly probable forecast sales, which will happen, let us say, next financial year, the realized gain and losses would continue to be forming part of my other comprehensive income. In such cases, that realized gain and loss will have to be factored in for the purpose of computing cash profits or cash losses under this clause. And subsequently, let us say in subsequent financial year, those realized losses are classified to income statement in subsequent year, then you need to make an adjustment in that year to say that the transfer from OCI to profit and loss is treated as non-cash item. So we need to track OCI items separately and we need to track profit items in the profit and loss separately to come to a computation of cash profits or losses. In case of non-India's companies, it is that way much straightforward, because you just need to look at profit after tax and then adjust that profit after tax in the P&L for non-cash item like depreciation, amortization, impairment, etc., and then come to a situation of cash profit or cash loss. Here, important element to note is, let us say if there's a qualification in the audit report, then auditor need to evaluate whether this qualification would have any bearing on the determination of cash profit, and if so, we need to make that adjustment. That is one. Secondly, they also need to be mindful of if the qualification is not determinable, in the sense I'm not able to determine the amount of qualification, then those will need to be reported to say that we are not able to evaluate the impact of those qualification in terms of computation of cash profit and cash losses. Similarly, if there's a restatement, then the restatement impact will also need to be evaluated for the purpose of reporting whether the company has incurred cash profit or cash losses. Here, there could be a situation that in current financial year, company is having cash profit, but in the preceding financial year, company is having cash losses. Those reporting needs to be factually made. So you may have to report that in the current year, there's a company has not incurred cash losses, but in the immediately preceding year, company has incurred a cash losses of rupees, maybe X rupees. So those factual reporting need to be made in the respective year. Clause 16 and clause 18 are relevant. So clause 16 is more to do with CIC companies, which is core investment company, and there are 3 clauses that whether they have a valid license for conducting the business, are those conditions which will make them eligible to be a CIC are fulfilled, And secondly, if in a group there are more than one CIC, what are the details of those CIC? So this is again applicable and restricted to only core investment company and not for a wider client base. Clause 18 is relating to resignation of the auditors. So here, when there's a resignation of the auditors by way of a casual vacancy and the new auditor has come on board, auditor need to specifically comment in the CARO report that he has considered the issues, objections, concerns which are being raised by the outgoing auditor before accepting the audit or as a part of the audit procedure that he has performed. So a specific confirmation and confirmation is required now by the incoming auditor to say that he has evaluated those objections, issues, conditions, concerns, and has factored that in as a part of its audit. So while this is from a professional standpoint not a new requirement, because we are always at a part of our code of ethics, we are required to evaluate those issues. But now specifically I'm supposed to comment in the CARO report that I have looked at those issues, objections, and concern raised by the outgoing auditor. So no big change. Additional requirement is just to report. Moving on to the next clause, which is on the financial position. Now this is a very qualitative requirement. Here the idea is that based on evaluation of ratios, evaluation of aging, and expected realization of financial asset, when the financial liability will be expected to be paid, knowledge of the business, board of directors plans, etc. If the auditor is of the view that there is no uncertainty exist, that the company will be not able to meet the liabilities which are existing as at the balance sheet date and payable within next 1 year, whether the company will be able to pay those liabilities or not. So the reporting is on whether there is a material uncertainty as on the date of the report that the liabilities existing as at the balance sheet date payable within 1 year, company will be able to make those payments as and when those fall due. So a very qualitative reporting, and for this purpose auditor would need to really evaluate factors like ratios, aging, debtors, payment, when those pattern of payment are due, when the assets are going to be realized, etc., and then form a view whether company would be able to make those, would be able to discharge those liabilities or would find challenges in discharging those liabilities. So very qualitative reporting that need to be evaluated and judgment need to be exercised for the purpose of this reporting. If the company that you're auditing is a holding company which has given some guarantees, security or commitment on behalf of subsidiary companies, then for the purpose of this reporting, we also need to factor in whether there's a probability that any obligation would devolve on the holding company on account of defaults being made by the subsidiary company. And if so, what will be the amount and the timing of that amount? And that would need to be factored in as a part of our assessment on the holding company CARO report, so that we are able to have those cash flows factored in before making the assessment on the holding company financial statements. Here we need to look at, as I said, ratios, correspondences, ability to settle liabilities, what are the historical trend of settling the liability, what is how much of the liability which was due subsequent to the balance sheet date has been actually paid by the company, etc., and then formulate a view on as a part of this clause. Moving on to clause 20. So this clause 20 is more to do with reporting on CSR. So there are two sub clauses. Clause A deals with other than ongoing project, and clause B deals with ongoing project. Here I'm supposed to factually report whether in case of any unspent amount which are relating to other than ongoing project, whether the company has transferred that unspent amount to a specified fund under Schedule 8 within 6 months from the date of the financial year, from the end of the financial year. So as per section 135, if you have an unspent amount and it is not relating to any ongoing project, as per section 135, company is required to transfer that unspent amount to a specified fund within 6 months from the end of the financial year. And if company has transferred that amount, we need to report that fact. If they have not transferred that amount, we need to report that fact. This is for other than ongoing project. When it comes to ongoing project, the time limit is much shorter, whereby under section 135, if the amount relates to an ongoing project, we need to transfer that unspent amount to a separate bank account, which is open specifically for this purpose for the within period of 30 days from the end of the financial year. And once you transfer that unspent amount to a separate bank account, like the way you have unpaid dividend account, then subsequent expenditures for that ongoing project need to be made from that bank account. So once you transfer the money to a separate bank account, you incur those expenditures from that separate bank account over a period of 3 years. And let us say even after 3 years, the amount remains to be unspent, then you need to transfer that amount to the specified fund. So these are two specific requirements under CARO, whereby we need to comment whether the amount has been transferred, whether for ongoing project or other than ongoing project, within the time stipulated under the section 135. Here we need to be mindful of the categorization of the unspent amount into ongoing project and other than ongoing project. Typically, ongoing project will be something which is a multi-year project, which is having a time zone of about 3 years. Along that project, like building a dam, creating a reservoir, or maybe construction of a school building, which normally takes substantial period, maybe 2 to 3 years. Those, if the company has earmarked certain funds for those projects, those will be called as ongoing projects. And to the extent the unspent amount relates to those projects, then those will be treated separately. And if there are no ongoing projects specified, then whatever unspent amount, those will be treated as relating to other than ongoing projects, and those will need to be transferred to a separate fund formulated by the government. So this is again a factual reporting that is required to be made. We need to look at the balance sheet position of unspent amount, how much of that relates to ongoing and other than ongoing projects, and then depending on the requirement, whether those amounts are being properly transferred to a separate bank account or to a fund. There could be a situation that I am signing off my opinion, let us say in June, and company has time till September to actually deposit an amount to a specified fund. In such cases, we need to report that company has not transferred the fund, not transferred the unspent amount to a specified fund, but the time required or time permissible under section 135 is still not elapsed, and company has a time to make that payment or to transfer that fund to a separate fund subsequent to the report release date. So those factual reporting can be made as a part of a CARO report. Coming to the last clause, which is clause 21. This is the only clause which is applicable to consolidated financial statements. Rest all clause 20 are all relevant and focused on standalone financial statements. This clause requires the principal auditor, with the company or the auditor which is auditing the consolidated financial statements, to report any adverse or qualified remarks which are included in the subsidiary company's CARO report, and that company is getting consolidated in the consolidated financial statement. So two conditions need to be fulfilled for the purpose of this clause. One, there's a subsidiary company which is getting consolidated as a part of the consolidated financial statements of the company, one, and the CARO 2020 is applicable to that subsidiary company. So for example, if CARO 2016 was applicable to a subsidiary company because maybe a year end is December, then this clause is not applicable so far as the CARO report of that subsidiary is concerned. Also, if a subsidiary is very small and the CARO is reporting is not applicable to that company, again, this clause is not applicable to the principal auditor. This clause is only applicable where a subsidiary company's auditor has issued a report under CARO 2020 based on the evaluation of that subsidiary company financial statements, and there are qualifications or adverse remarks which are included in the CARO report of the subsidiary company. So if there are, say, everything is normal, there are no adverse remarks, then nothing is to be reported as a part of the principal auditor's CARO report. Now, we need to be mindful of what is qualified and adverse remark versus statement of fact. Most of these clauses under CARO 2020 could be either statement of fact or could be involving exercise of judgment and opinion on the part of the auditor. So if it is a factual reporting to say that company has, factual reporting around there's a default in repayment of dues, or factual reporting on cash losses are being incurred by the company, those are not treated as something which is adverse or a qualification. But let us say a subsidiary auditor has reported that based on the evaluation of financial position, the subsidiary company is unable to meet its contractual obligation, which will fall due within 1 year. Those will be something of a qualified or adverse nature, and hence those will get reported in the principal auditor's CARO report to say that, okay, this is for this particular company, this is the clause number for which adverse remarks have been made by the auditor of the subsidiary company. And while the requirement is not to reproduce the CARO the language of the CARO report of the subsidiary company, but as a good practice, it can also be considered to be included by the principal auditor, to be included the language of the adverse remark to be included in the CARO report of the principal auditor. Here, what is important is when I evaluate the reports of the subsidiary entities, I don't need to evaluate basis the materiality of the console financial statements. Each and every adverse remark which is there as a part of the subsidiary company's financial statements, CARO report, all need to be considered and evaluated and reported as a part of this clause. So I don't exercise my judgment as a principal auditor to say this is very small matter and I would not include it. So long as there's a qualified and adverse remark, everything and anything will need to be brought down in the principal auditor's CARO report. So that is more important. So when I'm reporting on it, I need to exercise judgment whether it is a factual reporting or not a factual reporting. But materiality evaluation is not required or not permissible as a part of this reporting under clause 21. So this is a one clause which is applicable only for the parent company auditor. Rest all are all applicable to standalone financial statements. I'll move to the section where there are not too much change. So these are some of the clauses where there is hardly any change compared to CARO 2016 versus CARO 2020. So clause 1, clause 4, 5, 6, 10, 13 and 15. These are the clauses where there's no change, and then the requirement continues to the way it was there in CARO 2016. So I think with that, I have come to an end of my presentation. I hope you found it useful, and if there are any questions, I can take them on board.
प्रवीण सर,
या हाय
सर 2-3 क्वेश्चन है सर, मैं आपको चैट बॉक्स में दे दे रहा हूँ सर.
हाँ, आप मुझे पूछ सकते हैं अगर, because chat box maybe it will be for benefit of everyone also, if you can.
तो दिखा आपको क्वेश्चन सर? प्रवीण सर चैट में देखिए.
One second. So there are various. I'm not sure. I'm not able to. Okay. Clause 14, internal audit. Okay, I'll go one by one. Yeah, the first one is inventory. In case of private company whom limited review is not applicable, it may not be possible to match return with books. How to take this issue? And maybe audit purposes, they may match the book numbers with return, later change the numbers. So I think there's a question about if for a private company, quarterly limited review is not applicable, then how do we deal with this clause? So I think what is important is, while quarterly limited review is not applicable, what you can do is you can maybe have a discussion with the client now to say that this is a new reporting requirement which has come up. You need to maintain, or you have to maintain and provide me with the information of what was submitted to the bankers as a part of the quarterly returns and the statements, and what is the backup of that, right? Okay, and when you get those information which is being filed by the company and those information which are being maintained, you need to really compare those and confirm whether those are really matching or if there's a difference. I understand now, sitting in December, how can I really go back and vouch for that information? So here I think what is more important is, as I said, this information is required to be disclosed by the management in their financial statements also. And as a part of the controls, I would advise that they should have maintained a control about preparation of this information, comparing that with the books of accounts, and there has to be a sign off. The way we have bank reconciliation sign off or any other controls, there's a proper sign off which is being done and maintained. And so long as there's an adequate documentation about review, supervision, and you are able to corroborate that basis the work that you perform as a part of your audit, I think you should be able to rely on that situation. Am I able to respond to your question, sir? Okay, I will move to the next question, which is how many times Q4 report is not available for statutory till the signing? What should be reported? Okay, so this aspect I think I have covered as a part of my my presentation. So here, what is important now is now everybody is aware that specifically we are required to report that the internal audit reports are being considered by the auditors. Let's have a dialogue now with the client and with the internal audit team to ensure that we get the report well in advance by the time we sign off. But suppose for any reason those reports are not being made available, then of course factually we'll have to report in our CARO report that the internal audit report for Q4 is not made available to us, and we are unable to verify and evaluate the report which is not made available to us. So in all rights, make that reporting in CARO factually to say that the report is not made available to us. Inventory 10% is quantity or value. So I think this is a good question again. Previously, the requirement was to report on material discrepancies, but now the threshold is 10% or more, and that 10% or more threshold is to be applied on the value of the discrepancy and not on the quantity. So you need to take into consideration the value of the discrepancy and compare that with the book value of the inventory that is there. So it is based on the value and not on the quantity. I hope there were 3 questions and I have been able to.
Yes, sir. Yes, sir. Yes, sir. Three questions. Three questions.
Yeah.
Jay, sir. Jay, Tucker, sir.
Yes, sir.
Okay, sir. So the question is, thanks.
Yes. Yes, sir. Thank you very much. I really thank WIRC and our chairman, CA Manish Gadia ji, for giving me this present task and this opportunity to propose the hearty vote of thanks at the end of this session. But before we move towards the vote of thanks, I really appreciate the way today's faculty CA Pravin Sethia sir has covered the very relevant and the important topics on the company's auditors reporting order on 2020, the reporting requirements and the key changes. Sir has covered from the introduction to the objectives and the applicability. He has discussed the close by close issues, covering the each aspects, all the relevant important aspects. In his presentation, we can see it was a very detailed presentations wherein he has covered the reporting requirements along with the respective guidance note, and the very important part of his presentation was the key considerations, what he has mentioned in the bullet points for the each and every clauses. It was the very relevant and the important aspects of these presentations. And so he has touched upon all the relevant important clauses, like the unrecorded income and the repayment and the applications of the borrowings. He has touched upon the reportings on the fraud, cash losses, etc. So truly, Pravin sir, it was very informative and it was very helpful to all the participants. So we thank you very much for giving your valuable time. So on behalf of WIRC of the ICI, we propose our hearty vote of thanks on the behalf of the chairman, on the behalf of all the participants. Thank you very much for giving your valuable times. We thanks coordinator CA Nidhi Lalpuria and CA Palak Shah for helping us to have today's session. So thank you very much to everyone and the participants also. Thank you very much, everyone.
Thank you, Jayesh, for this wonderful vote of thanks, and thank you, participants, for having a patient listening. I hope you
Thank
found this useful.
Yes.
Thank you.